You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that rockin' tune means it's time for TWIFO, This Week in Futures Options, a program where, as the name pretty much breaks it down, we break down the week that was and indeed still is on the futures options side of the fence. So all the hot action over there in your commodities, your indices, your ags, all the other products you don't get a chance to talk to too often on our other programs. My name is Mark Longo from the old optionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you're just listening to TWIFO now, first off, welcome. Secondly, got a whole other world of programming out there for you, 14 other shows to be precise. Easiest place to find them all is wherever you're listening to this. Go on over and grab our full network feed. Just search for our network pretty much, and you'll find it. That's, again, 15 shows. That's our daily news show, our option block show a couple times a week. Volatility views we just finished up. A lot of stuff going on in that realm, as you might imagine, this week. All sorts of fun stuff. The advisor's option, our tech show, you name it, it's all mixed in there. Subscribe to that. We got you covered then forever with all the options content you could ever possibly want. Of course, you can always find it over there on our website as well, or wherever you find your mobile apps. Our app is out there for you too. And you can also, of course, join us live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern via Mixlr, MIXLR. So if a hot week like this, you want to get in there and really listen to it live, listen to us break down the action live, that's the way to do it over there on Mixlr. And of course, however you listen, hit us up, questions, comments, insights. We do love to hear from you guys. After all, it's boring if it's just me and Nick talking. Speaking of Nick, let's bring him on, my co-host, my cohort, my partner in all things futures, options, crime, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little analytics platform we've used once or twice here called QuickStrike. Mr. Nick, welcome back to TWIFO, sir.
Hey, man. Good to be back. I liked hearing the pit noises in the background when the guys are on the line, so I'm looking forward to hearing some more of that.
Well, we will have a lot of that coming up because, as you mentioned, we are joined this week. We thought, an epic, some may say historic week out there for the markets and the S&P, certainly for this year. Aggressive sell-off out in S&P. What better thing to do than to bring in a couple of the guys who are there right now, live. They've been filling paper over the last couple of days and paper for a while before that, so they can kind of walk us through what they've been seeing out there. We are joined now in the old CME Group hot seat by two guests, by Joe Sullivan and JJ OKeefe. They are brokers over there at Chicago Capital Markets from the floor of the CME Group over there in the S&P options pit. Joe and JJ, welcome to TWIFO.
Hi, guys. Thanks for having us.
Thanks for letting us have some of your time here today.
Yeah, it should be fun. I think this is opportune timing for everybody. This is a good time to kind of get a peek behind the curtain, if you will, on what's going on. But before we do that, really quick, I know we're kind of pressed for time. This is obviously a busy day for you guys over there as well. So really quickly, as we are wont to do with all of our first-timers on the network, why don't you, Joe, and you, JJ, both really quickly, abbreviated, give us a quick overview of your background in the space and what the heck it is you guys actually do over there at Chicago Capital Markets.
Okay, so my name is Joe Sullivan. I've been working down here since I was a runner in high school. So been down here for about 20 years, worked my way up, runner, clerk, and I've been working in the options space now for about 10 years. Partnered up with JJ about 5 years ago, and we broker for a lot of different asset classes, but primarily S&P options. So we are just outside the pit here. We have a customer base that ranges from like $1 million under management up to $4 billion, and we're fairly active on a daily basis. And JJ and I have been, I say that already, but partnered for about 5-7 years.
Yeah, so, and my name is JJ OKeefe, and I've been down here about 12 years in the trading space for on and off for about 15 years. Worked as a local and switched over to brokerage when I found out I was no good at trading as a local, a little better as a broker. But no, I was able to, we were able to bring some clients over, and like Joe said, ranges anywhere from really small traders to some bigger sized funds. So, and that's kind of primarily what you do see here. You see across the board in the S&P options.
Joe, I got to ask you, the name Joe Sullivan, a bit of a storied one in the index brokerage space and in the option space in general. I mean, there was a Joe Sullivan, a broker out in the SPX pit in the CBOE when I was over there. Of course, the Sullivan Award that's actually given out every year by the options industry is named after Joe Sullivan, one of the early members of the CBOE. So I have to ask, any lineage there?
Absolutely no affiliation.
None,
Yeah, me or my family are not to. We have any kind of remarkable award-worthy status whatsoever. But it is a very popular name. A lot of my competitors talk to a few brokers named Joe Sullivan, too. So we can get to in the city of Chicago, you get a lot of, there's Joe Sullivan is pretty popular. But I do not have any lineage in the business whatsoever.
Yeah, who knew? Joe Sullivan, apparently the go-to name for S&P brokers these days. I dealt with the Joe Sullivan over there in the CBOE back in the day. So yeah, apparently that's the go-to name for S&P brokers these days. But speaking of go-to, you guys are kind of the go-to guys. You were down there. Let's dive right into it. For our listeners, a lot of whom maybe have never been down there and certainly not in the heyday of the floors. You guys are obviously, the floor is obviously still fairly active. Let's start with this, kind of walk us through what yesterday was like for you guys. I mean, obviously yesterday, a very aggressive sell-off, one of the biggest ones we've seen certainly this year and in quite some time. Volatility spiking. I'm sure the orders were flying fast and heavy yesterday. So walk us through what you were seeing, what your customers and clients were trading, what they were looking for, and kind of give us a general sense of the day.
Yeah, so it was exciting to finally come into some volatility. What we have, with the VIX rallied about 40% yesterday.
Yeah, pretty much.
Maybe even higher, which was on the heels of us coming off 35 handles. What about 1.5% in the S&Ps? So we have the clients around here. You've probably read about these short. There's a lot of guys that are just naked short puts. So you come in and you have some guys that are going to buy stuff back or roll stuff out. And it's exciting because, as a local or a broker, you know which way to lean it. And these guys probably bought back or rolled out 5 to 10,000, small delta, 10 to 20 delta puts, which is, it can make for an exciting morning. And there were gyrations, and there was actually some two-way trading with a lot of guys trying to get long some stuff as well. So that's what happened in the beginning of the day. Joe, what do we do for our guy starting the day?
Well, we were bought it back. We were buying a lot of the 18 half puts in October.
Right. So we've been trying to also, for the last month, hoping that we have one client who's kind of hoping to see some volatility. We've been trying to buy some back month small puts, and those were more difficult to get our hands on yesterday. But again, I mean, you come in here, you get a sense that there's going to be some vol, but you also get a sense for the last 7 years that you've come in and every bounce has been bought. So a lot of people were a little tentative, like, all right, well, when does the plunge protection team come in and just scoop everything up and we're back at unchanged? And for the first time in a long time, that didn't happen. So you definitely see some fear in some of the traders on the phones. You can hear that fear, and you can see the locals salivating a little bit, saying, okay, we can widen stuff out and maybe make a little money for once this year, which I think some of them did. They were able to sell little put spreads for a lot of edge, and that's when they make their money. And most of the big traders that we have in this bit are kind of leaning towards, a 2 to 5% correction. So they're pretty happy to see that as well. The trading was, like you said, it was throughout the day. It was constant. It was energetic, and it was volatile. And those are all the things you want to see as a broker and a trader. But we probably only had 2 or 3 of those days in the last year.
Yeah. The big trade in the morning was in August. 21 half, 21.80, 22 half put fly, and paper was buying the middle pretty actively. So that was like what we walked into in the morning, and I think that they were paying. It seemed like they were paying anywhere from 20 to 30 cents over sheet. So locals were happy to sell it to them, and there was enough liquidity, obviously. So the end user was fine getting out of his position there. But that's kind of how we started the day off. That traded. When we say our size here, for those who are listening, the multiplier is 5 to 1. So when we say 10,000 traded here, that's like 50,000 minis for those who aren't.
Or 25,000 SPX, right?
Right.
So yeah, we're 2.5 times the size of the SPX and 5 times the size of one mini.
You got to love that. Everything's hitting the fan first thing in the morning. And the guy's pricing up a 3-leg.
Come here for that kind of because they want to get their size done. And you had a great conversation with the guy from the box yesterday, and he talked a lot about. And I would echo a lot of things he said in terms of why we think that this is still an important and valuable place to get stuff done. And anywhere from hedging, buying small protection to getting complex trades done. And we saw some of that yesterday as well.
It's funny. You got everything's hitting the fan yesterday, first thing in the morning, and what's the guy doing? He's quoting a 3-leg fly. You must have been enthused by that. You can't be doing something straight up out of the back, just buying some calls or buying some puts. He's got to have you work a 3-legged order. But it sounds like he was paying up for it. So I guess, like you said, the locals were happy. Trading things over sheets is always nice. Let's give them a little flavor too for what you guys do. Like you mentioned, floor-based execution is kind of what you guys do. A lot of people have this perception of the E-mini going up electronic and stuff, doing their 10 lots and things like that. That's probably what they have their perception of kind of S&P options. You guys are handling probably a little bit larger, a little bit more institutional clientele who still really prefers kind of the high-touch execution. Maybe they're working a large fly, like you said. Maybe they're doing some sort of other complex multi-leg order, and they really rely on you guys to kind of get a feel for what's out there and work the order and that sort of thing and shop it for them. So maybe walk our listeners through a little bit, too, the different clientele you guys may handle versus your typical retail guy who's just buying a 10 lot of, E-mini calls through their retail broker.
That's exactly right. So we handle, like we started off saying, our customer base varies, but on the top end we do have some bigger funds that we work with, and it's not enough for them just to look at the screen and see a market and say, okay, I can do it for this price. Because once you get to the screen and you get, things tend to move around a little bit on you. So it's nice to know, you talk to or a couple of guys that work for us, and we talk to 5 to 6 different market makers. We talk to Optiver, we talk to CTC, we talk to IMC, we talk to, on the bank side, we talk to Credit Suisse, we talk to Barclays, we talk to, you name it. We have a phone line into them, and if we don't, our competitors do. And that's the nice thing about the pit is that once the order goes up in the open outcry, everyone's calling around on it because everyone wants a piece of it. So the market is about as true and as tight as you're going to get. Now, order flow goes as, we'll get a call in the morning. Sometimes we'll have a GTC coming in along those lines. Some of the funds we trade for have a rolling 3-day order somewhere in there. But we have a pretty good indication of where things are going to trade because we can tell them with certainty. Obviously we can't guarantee a price, but we have a good idea of parameters, which is much better than for someone who's managing, $1 billion wants to know when he's coming in with 1,000 lot that he's not going to have too much slippage. So it's easy to kind of execute on the larger side still in the pit space, which we've seen a lot of inflow in customers the last, probably 2 years or so who have started to realize that.
Yeah, and the mechanics goes, it's really, like Joe said, pretty simple. Our guy will call or a local will call, but mostly it's the end users that call. Will call us. We have to go to the pit, whether we arb it or we yell it in. We get a market from the pit, and we give it to the boss or the end user, and he'll say, okay, well, I need to get it done up to this price or down to this price. And then we hit the phones to those banks or to those locals, and then the locals in the pit. And like Joe said, I mean, as far as price discovery goes, and as far as getting size done and ratios or 1x3, 1x2 by ones or whatever it may be, we still think this is the place to do it. And I think if you can get an end user, especially the big ones, they'll agree. Just in terms of getting one price and getting it done, and then getting, so you want another 1,000 done, getting it done at that price. I mean, a lot of these guys, they don't want to deal with 15 different prices on the minis and seeing a couple hundred lot go away, and then it's 30 cents further away. We get it, we size it up, get it done, and move on, and they seem to like it that way. And like Joe said, there's more people coming to bat lately than we've seen go away, which is a good sign for us.
Yeah, people certainly did like it this week. I think that's a good way to put it. I'm looking at the numbers here over there on QuickStrack. By the way, listeners, you guys, as always, can follow along, generate your own reports, cmegroup.com/TWIFO, TWIFO. You can do exactly what Nick and I are looking at right now here and generate your own reports. I'm looking at the big S&P options. We look at E-minis a lot. I'm looking at the big S&P. It was pretty much a robust week. I don't care how you cut it up. About 19% open interest in the E-minis, almost 30% in the big S&P options, which is, of course, where you guys, Joe and JJ, play. I'm looking at here what the hot bullets, hot strikes for the week were out here. And the number one trade looks like by a mile were the weeklies. Look like the week work 4 actually expiring on the 18th, 2,100 puts out here in the S&P, 15,000 of them, 300 of them going up yesterday, and pretty much looks like a massive block. Most of that opening, that's the number one by far, followed number 2 by the 2210 puts, about 13,000 of those bad boys. Those a little bit more spread out throughout the week, 6,500 yesterday, 4,800 on Wednesday, and then about 1,700 on Monday. So yeah, the weeklies are still kind of, looks like at least this week where the action was. Would you say that's a typical week for you guys? Most of your, obviously not the volume, this was a crazy week from a volume perspective, but from maybe a product perspective, is that where a lot of your clients are coming to play? Are they playing in the weeklies and the short duration stuff, or are your institutional clientele still more interested in longer term type trades?
So it's a good question. We see both, and I'm not hedging. I mean, the institutional guys that, at least that we trade on behalf of, he likes to go out all the way to, we see a couple guys go out to October, November, and even December. But the weeklies, now it's hard to, how we talk about this, it's semantics, because everything over at the CME is kind of turning into weeklies, right, Joe?
Correct.
So, I mean, they chase, with everything going off at 3 o'clock instead of 3:15, we call everything week 1. Even what used to be just a regular August option is now a week 3 option. So that's all new to us. But it's neither here nor there. It's week 1, week 2, week 3, endo, and then only the quarterlies are traded as March, June, Sep, and Dece. But anyway, we see, as far as the near term and the far term, the near term, which getting back to something that, again, I think I heard on one of your programs in the last couple of days, is these guys, we have sellers of teeny puts and teeny calls, dimes and nickels and 15 to 20 cents, and we find that the institutions love scooping that stuff up.
So cheap.
It's
yeah.
So, it's a great, cheap way to protect your, I don't know, protection's a big word, but at least it makes the banks think you're protected. But you're buying a nickel put, a couple hundred points out of the money, and it makes your portfolio look like it's balanced and within the margin restrictions. And we got there's a guy in here or a fund in here that sells 5 to 10 to 20 to 30,000 of these things a day.
Yeah, like today he sold the 2075. The 2075 puts have traded roughly 12,000 times in that area. Paper sold for a nickel.
For Monday, right?
This is for Monday, yeah.
For a Monday put. Because now we have Mondays, Wednesdays, Fridays. There's a million expirations. But yeah, the near-term stuff is there, and it's really attracting the banks and the institutions to say, well, this is a great way for us to scoop up some cheap risk. And the seller's happy to sell it because he feels he's got the Yellen put taking care of him, and he's been right for 8 years. It's amazing to watch a guy make tons of money selling nickels and dimes, but he's done it, and the banks have been happy to buy it. So the relationship is symbiotic in that way. And then the farther term out stuff is not as much, but we do see it, and the stuff is a little more complex out that way. But it's there.
It's kind of funny. It doesn't matter what pit you're in. When I was in the SPX or in the now here, the decade or so later in the S&P pit on the CME, pick your poison. There's still the equivalent of the teeny put, now nickel put seller out there. They never go away. So there's
it used to be sell a cab, drive a cab, right?
Exactly.
But now they sell a cab.
Exactly. I used to joke those guys they'd have a different jacket pretty much every quarter or maybe every year because that's a long-term risky way to make a living. But it seems like the risk appetite for that never goes away, huh?
It never goes away. And then when they do get hurt, they lick their wounds and they get some money back and come back. We don't want to see them go away, although I would like to see a huge amount of volatility, and I would like to see. We always like to see. I don't want to say squirm, but I'd like to see some movement to the downside. And he's been smart. Don't get me wrong. This guy who's trading this, he knows what he's doing. He protects himself well. And there are still nickel puts, and dime sellers out there, and even on the call side, daily. Daily, they're selling the tomorrow call, and locals scoop it up because it's a great way to protect their margin.
Yeah, but the Wednesday 25, into the Wednesday 25.15 to 25 quarter range, next Wednesday 25.15, 25 quarter range, about 3,000 to 5,000 calls have traded there for a nickel already today. So you do see that more near-term stuff trading for size, and a lot of it is for risk reasons, exactly what Jay was saying. So we'll see guys trade some of our bigger stuff, and then if it's getting close to expiration, they'll hedge a little bit with what's out there that's really cheap in the near term.
Hey guys, this is Nick. I just had a quick question, just from a practical standpoint. If you don't know, I was in the Eurodollars back in the 90s, from 91 to 98. And
so you were there. You were there in the heyday.
When it was good, when it was pretty good.
By the way,
But one thing I remember, I started out at O'Connor and Associates Swiss Bank, and I remember, when I went down there, I think we were trading like 8 contracts, and then by the time I left, we were making markets in, maybe 30 contracts. So I know the week 3s now are the old serials, right? That was the change that the exchange made for you guys. So you hear a lot of moans and groans from the guys in the pit about all the extra weeklies that they have to do because, as much as you can run sheets, or now they got the screens, we had sheets, right? So we were fanning, 5 colors and 30 sheets across our hands. But I'm imagining you get a few moans and groans, right? Because there's more hand signals now, and it's a lot of words.
They don't like to think outside of their handhelds, So when you have to look at a calendar too now and look at what day everything is expiring, it's just there definitely is an audible sigh every time you come in with I'm going to trade a week 1 versus a week 3 versus a week 1 and next week or
versus
next month.
Monday, yeah. So if we still had the sheets, because when I started, we did the same thing. We had the print out of several trees of sheets for the morning, and if you had that, there would just be no way of doing it. But now they can. Now I think it's for them to add it to their matrix. But you still are like, oh my god, I got to trade a Wednesday option. All right, I'll make you a market, but it's going to be wide, and it's going to take me a couple minminutes.
Right.
But
for sure. No,
and some guys won't even do it. They're like, you know what? I'm trading 3 months out, like I always have. I'm trading endos and I'm trading cereals, and don't ask me for a market and the other stuff, and that's my business.
Right.
That way.
Yeah, we had guys like that stuck to, you know, the front calendar, and then the two serials that traded with it, and that was it. But they were quick and they were fast and they had good size.
Yeah.
But so I think you guys are kind of in the same boat. You know, you were mentioning it. I'm sort of on the fence about the floor versus the electronic. I mean, I get it. For you guys, because of the big contract, and for the large funds and institutions that have to hedge, it makes a lot of sense for the SPUs to still be there. And then for the Eurodollars too, I think it makes sense just because you mentioned it early. When you start doing these, and the Eurodollars is famous for it, these multi-legged, almost stupid contracts that you got to quote. You just can't get those on the board. But if you're seeing, I'm surprised that you see butterflies and stuff in there, although it does sort of make sense given that this market hasn't moved. So a butterfly would be a trade, especially if you got guys thinking a 2 to 5% correction. You know, butterfly seems to fit into that scheme. But what's the sense? Because I know a lot of these kind of weekend guys that sell puts and they think they're traders and they make money because we haven't gone down. But you know, do you see a lot of small lots coming in those 5 and 10 delta ranges, or is it mostly, you know, these?
No, you're right. I do. They're still here, and they've actually. It's kind of like when your grandmother asked you if you should buy Apple. There's more of those market topping kind of indicators that I'm seeing where the more of the small, and I don't want to see anyone get hurt. I don't want to see a 10 lot guy who sold a 10 delta put get run over the next day, but we are seeing more of it. They're still here, but like you said earlier in the beginning, like you'll see those guys on the minis more than you'll see in the bigs. But we still have a guy that calls daily for 6 and 7 and 10 lots, and he's happy to trade it in here. I think it's just because that's the way he knows it. He's been around. He's always done it this way. But yes, we still do see those 10 to 20 delta, little put spread, little put outright sellers, and collars and whatnot.
Yeah, for sure. And I always my saying is, it works great till it doesn't, right? And that's kind of how it's probably going to be. So anyway, Mark, you were going to ask these guys. So you know, just from what I could see, just from the last runs, you guys got a pretty good pump and vol because you were really, really low. So do you see this? Do you see that you need another 1 or 2% to have this vol stay bid, or do you think? I know it's come off a little bit today. I believe it's come off a little bit today.
It's actually coming off its lows nicely as we've been talking. It's rallied. The VIX has rallied from down like 90 bips to down only a quarter. And I don't think anyone's going to go short, going to the weekend short. And I think you're going to see the VIX unchanged or higher by 315. And yeah, the market's showing weakness as we speak. We're back towards unchanged, and we were just up to $8. So I don't think, you know, with North Korea and the White House and everything else going on in this world, I think both people are like, all right, I'm going to take some profits and go home either neutral or short, but not long. And you're starting to see that right now. And I do think the VIX has some room. Historically, what is it, around 18, 19? We just got down into the 8 handle in the last couple of weeks. So I think it's going to see. I still think the VIX has room on the upside, and obviously the SPUs concurrent to that have room to the downside.
Yeah, I mean, me personally, I'd like to see us get down to 2000s again, to be honest with you. But I don't know. It would be great for the markets in general. It would be great for the rates. But it'd also be good because if anybody's got cash sitting around, that nobody really wants to get in up here. At least from my perspective.
Yeah, it's very true. Very true.
It's a scary thing, but right.
The old chimes on the old CME floor. I haven't heard those in quite a while. I like that. But you mentioned, you're talking volatility, and obviously you mentioned this week has been a crazy one for volatility. S&P vol, aka VIX, spiking up about 40% yesterday. You mentioned kind of coming off and maybe getting a little bit of a bid again as people afraid to get short over the weekend. I'm curious, for you guys who make your living as brokers out there, you need contracts, you need flow, you need a little bit of, shall we say, juice or volatility to really get things going. What's it been like for you for the rest of 2017, pretty much until this week? Were you guys kind of wringing your hands as like everybody else out there, saying, man, we need some vol to really kick things up out here? Or, were your clients still pretty active even with the pretty much single-digit vol we've had for most of 2017?
Exactly what we're looking for. We have been taking a lot of vacation time this year. There's been a lot of days off, a lot of paint drying when the SPX prints, in the 72 range for 17 straight sessions or whatever it was. There's really not a lot to do. So
there's an old adage in trading that you make 90% of your money in 10% of your days, and I think that that applies to brokers and traders. You sit around here, and those 10% of the days where we have VIX that moves 30 or 40%. everyone's trading, and hopefully the locals are making some money, and hopefully the brokers are making some money on behalf of their clients that are also making some money. And as we talked, the VIX just touched unchanged for a second. So there you go. I don't think people are as complacent as they were a couple days ago.
Yeah, it was funny out there. No one was buying the fire and the fury until everybody was buying the fire and the fury, and they all had to have it. Isn't that pretty much the way of the market? So since we're talking vol out there in the S&P land, Nick, I kind of just hit on some of the big hot positions and strikes and how much of an explosion we saw in OI pretty much across the board in the entire S&P complex this week. But I know you've been watching your quick skew and your vol out there as well. Break it down for us. What's been catching your eye out there? What's been moving and shaking from a vol skew perspective and from a vol perspective out there in S&P land this week?
Yeah, well, first off, I have one comment, and then I'll jump over there. And it's really interesting, Mark, because you and I we talk about this every week. But what I find intriguing that these guys mention the VIX, that they're watching the VIX, and then that's kind of as the VIX goes, you see how the S&P is going. So we're gonna have to, and I know that that's the case. I happen to, I'm coming at from another angle, so I don't, and the VIX is just a little bit foreign to me outside the fact of outside of the time that I've been working with you. But I find that intriguing that everybody's watching it, and it's sort of, I always feel like the VIX is a self-fulfilling prophecy, like the market's going down, so the VIX is going up, but whatever. Anyway, I find that I'm going to have to pay a little bit more attention, so I like that. And plus, whether we're even supposed to talk about the VIX or not is another thing. But from a vol standpoint, obviously the market's going to go up. The vol is going to go up when the market takes a little bit of a hit like this, especially when there's, rhetoric about fire and fury and locked and loaded from who. So it's sort of not unexpected, but it's been great. I mean, when we were down in the eights for so long in the volatility, it's really good to sort of see it up here because it just makes for a better trade. But as far as vol, you have. What's great about the S&P is you almost have something expiring every third day now, so you can really get a good feel for the term structure. And when you're talking about volatility, I don't really start looking at stuff until you're outside of 14 days or even outside of 20 days because you have so much decay inside those early expirations that vol doesn't really. It's more like almost trading like a binary to some extent. You're really trading movement. It's almost like a cheap future. So vol even out 28 and plus days, you have some pretty decent sized increases. 25 to 33 percent of the volatility increases over that time. But again, and I'm not shocked. And I looked at the Russell, I looked at the NASDAQ, I looked at the S&P this, over this week as we were having this break. The curve doesn't change. And I think that's the one thing that as a guy that was in a pit where you saw where, I'm sitting on this side of the pit because the put skew, handed me my, back in a certain day. So, you don't ever see this. I'm always intrigued to see that no matter what, this put's always going to be bid and the call's always going to be offered. And these guys gave a lot of insight into the fact that there's a guy that's out there, or there's a fund or a gal out there in a fund buying puts, and somebody else is selling them. So if somebody's selling them and somebody will scoop them up, and because they're so cheap, you're going to get that vol. It's going to be bid, right? So people don't look at they're looking at how much it costs, not what the volatility is when they're looking for that kind of protection. So that's a great insight as to why this curve is always going to be tilted the way it is. So even with the big, well, as you expect with the big break, you didn't see that much, a tremendous amount of change in the put bid, but you did see that the calls did get offered substantially when you look outside of 10 days and on, you saw the calls get cheaper than they were on this breakdown. So that's the first thing I noticed, and that's on the big contract. And on the little contract, you're not seeing so much of an offering on the call side, but the big contract, you definitely saw a percent decrease on the skew. So, obvious statements. We saw between 1 and 1.5% break. I'd like to see another 1.5% break, just like we talk about in the commodities. You like to see something followed up in order to get that vol to continue to be bid. And no surprise on the downside where the puts stay firm, but I'm a little surprised on how offered the calls got. But again, I'm not surprised because if we do rally back up there, they're going to hammer that crap out of that stuff. So, and I'm sure you guys can attest to that happening. If we do retrace, you're going to see, there's going to be some baths taken down there on any positions that are up around the, 2460 strike or 2470 strike.
since we're talking vol and S&P skew, I'm going to bump a listener question up from the mail segment. We'll answer it now while we got Joe and JJ here on the phone as well. This one comes in from AVN. He says, "Hey, vol's up in the S&P." Yep, he's right. He goes on to say, "What about the skew? Do E-mini, SPY, and SPX skew all kind of move the same?" That's something we talked about before. You just kind of broke down the S&P skews and how they're all kind of similar. But that said, since we have you guys on, I know you guys got to hop off to fill some paper in a little bit too. We got to move on to some other products. So Joe and JJ, what are your thoughts on this? And you guys obviously fill paper across products. You also obviously monitor the skew in other products, not just your own. What do you have to say for our friend listener here? AVN wants to know, how do these different skews in different S&P 500 products, how do they line up or perhaps don't?
They do 100% line up. I mean, you'll hear the locals say, say we come in and I buy, a couple of thousand October puts, and they're 10 delta puts, and you'll say all vols up in October or are 10 delta and lower, October and out, and then the guys will get on their horn because the complex goes. Obviously you guys know the SPX, the futures on options here, and the ES, the SPY. Joe, am I missing one? That's all of them. So they all trade together, and most of these guys will trade, some of the smaller guys just trade us maybe versus the mini, but most of them trade SPX, futures options, and then the SPY and the ES. And as soon as you move the curve here, it gets moved throughout the complex. Same on the call side. You can, someone will call me because I'm working in order to sell something on the upside, and a local will be like, "Hey man, that just got worse. Someone on the spiders just sold, 50,000 25 delta calls in November, and you're offering those. So it's just got lower on everyone's sheets across the board, whether you're in this building or the one across the street. So absolutely all lined up almost 1-to-1 in my view. Joe, you agree?
I completely agree. Yeah, the whole complex works. It's a misconception that you can try and pull the wool over someone's eyes and find vol. Try and sneak something in there. Once a big trade goes up, this skew moves across the board, no doubt about it.
Yeah, I mean, I just jump in. Mark and I have been covering the Russell the last 3 weeks too, since the CME reinitiated that contract. And I know it's only an E-mini contract, but we were kind of waiting for the vol curve to kind of fall in line with the bigger indexes, with S&P and then with NASDAQ, and it's gradually kind of gone to that. It was a little less steep than the S&P was, but over the last week or so, it's gotten to the point where it's definitely kind of almost matching where we were. I got one more thing. You were saying something about we were talking about on a retracement. What were you going to say about a retracement if we go back up to where we started?
All I was going to say is that you were speaking of, going, and I'll counter that a little with an opportunist. There was a big D's $25 call buyer in here today. We think it was a bank. We're not sure it wasn't our customer, but he bought about 2,500 big D's 25 calls this morning, ranging from $38 up to $40. Yeah.
Right.
That happened this morning on the open. Futures were trading a little higher, probably anywhere from 41 up to 43-ish. When that came in, but that was the big upside play call this morning that we saw.
But I think to your point about those upside calls, and I missed a little bit of it because I was paying attention to some in the pit. But to me, if you're going to take a shot on the upside, you kind of got to rip there, right? You got to get to 2,500 fast to make money on a $40 delta call. Otherwise, if we trickle up there, those things are still going to be worth $40 in a week or two, as we trickle back to 24.5. Am I wrong? Or is that kind of what you were saying about as the VIX gets smashed as we rally back up into that part of the curve?
No, that's exactly what I'm saying. It's the same thing. And I mean, it's not much different.
Unless you're long futures against them, but yeah.
Yeah, but people aren't those.
They're not.
Yeah. Odds are they're not doing it, right? Yeah, if you're hedging it, it's one thing. But that's exactly what I was getting at, is that, that curve just sort of decays. Yeah,
it doesn't make sense to me as a trade. So who knows what the guy's doing? He's probably got something more sophisticated going on. But if you want to get along that part of the curve and going into the end of the year, I'd rather be short that call tied to futures and have us trickle up there and have the thing go out worthless and make money on my futures. But this guy probably knows something else. So, but you're absolutely right. If we trickle up there, vol's going to go back to 9, and those things are going to get murdered.
Right. All right. Cool. Thanks, guys.
Interesting stuff on this question, because you're right. I was out there in the SPX pit, the SIBO, never on the CME. We had guys on the CME though. Starting about 97, and that's when I first started noticing the pits could develop a little bit of their own kind of paper. They have different clients trading each, but most of the market making groups would have people in both pits. So it was kind of one of the early ARBs going on. And then eventually, by the time I went out into the equities in about 2001, we had, or maybe 2000, it had already kind of switched to the point where if you saw a big print go up in one of the pits, the other groups would keep track of it. They would already jack their bids in whatever month or crush the vol and whatever, adjust their skews accordingly in the other pit, even if they hadn't traded there. So that was that period of where things would be kind of isometric and trade their own way in their own skew. That was gone by about 2000 at that point. So now it's all automated. We have the E-mini really trades a lot. So the notion of these things kind of trading independently on their own skews, you kind of got to go back a ways to really find that these days. So good question there, AVN. And, guys, Joe and JJ, I'm glad you guys could make it on the show with us today. I know I want to let you hop off so you can go fill some paper before the close here. It's still a pretty active day. I'm glad you can carve out a few minutes for us. But really quickly before you go, if you have any last final thoughts on, things you've been seeing out there in S&P land, or if you want to have, fill our listeners in, they like what they're hearing from you guys, maybe they want to reach out, maybe they got some floor business for you, where should they go? What should they do?
Well, I think we've covered nearly everything that we had wanted to discuss today, but it was a pleasure. And if you want to reach us, you can either email myself at jsullivan@ccmmarkets.com. I believe you tweeted out my Twitter handle as well. It's JPS Brokerage at SullyPod. Jay's email is jokeefe@ccmmarkets.com. And we really appreciate the time. And thank you very much, Mark. It was a pleasure.
Well, I'm glad get you guys on. And like you said, you guys are, everything old is new again. And the floor, like we mentioned, we had Ed Boyle from Box here. They have a new trading floor they're launching. NASDAQ just relaunched the Philly. So everything old is new again. The floor is having a bit of resurgence here in 2017. So you guys are on the cusp of everything new.
To be the case. So yeah, so the people out there listening, we're here, and that's I guess that's the one thing I would say is, as we've gone out there and tried to market ourselves, it is amazing how little that people realize that the big pit was still open. I know that as a lot of it closed last year or the last couple of years, but the CME and the options on futures and on the SPOOs, and then the Eurodollar, the Eurodollar is really keeping things going. So it's robust, it's active, and we'd like to keep it that way.
There you go. Check them out if you want some color from the floor. Maybe you got some business you want to send their way. Like they mentioned, they're over there at SullyPod, SULIPOD. on Twitter, or just reach them out, jsullivan@ccmmarkets.com. Glad we can get you on. We'll have to bring you back on another day. Maybe, hopefully not, depending on your view of another day when the S&P hasn't moved 1.5% in a day or so. But still, great to have you on. We'll have to have you on again down the road.
I'll be on whenever you want.
Great. Thanks, guys.
All right, boys. Thanks a lot.
Bye-bye.
Bye.
All right, Mr. Nick, that was fun. Always nice to get a little bit of color from the floor over there at the CME. See what's lighting it up, because he's right. The narrative has been everything's closing over there on the CME trading floor. But you know what? There's still some pits open, and the option pits are still active, particularly when it comes to complex orders. People still like that high-touch environment. I mean, they're launching new options exchanges left and right with trading floors attached to them. So they wouldn't be doing something like that if there wasn't some interest in them. Speaking of interest, Mr. Nick, I know you've been watching hot and heavy action out here this week in the metals as well. I guess we'll pick your poison. We'll start with gold, because that one's been pretty interesting. OI decent, up 4.5%. Of course, the underlying kind of heading off to the races, up about 2.5%, about 30 handles, just flirting with that 1,300 level out there again in good old good old gold. And once again, the action coming out there in the front month. And surprise, surprise, flirting with 1,300, front month 1,300 calls were where the action was. A total of about nearly 9,000 of those bad boys going up this week. Pretty evenly split, about 3,000 on Thursday, almost a similar number on Wednesday, and then the rest of the week kind of little smaller chunks there. But interesting stuff there nonetheless. The round numbers, the even strikes, still capturing the imagination of the folks out there. You go a little bit farther down, a little bit farther out, you also got the 1260 puts and 1275 calls, both doing about 4,800 contracts each. not to be left out. A little bit more active, a little bit more optimistic gold bugs out there in the October contract, also pretty active with these 13 halves, out there in October, doing pretty good paper, about 4,600 contracts going up out there as well, and not to be outdone all the way out in, what do we got here? We've got, these are Feb 2018 here, 1410 calls. That's an interesting strike. 1,002 of those bad boys going up, pretty much 1,000 today and 2 on Wednesday. So a little bit of action out there as well in the 1410s. Weird stuff. Speaking of action, I know, Nick, you were watching the vol and the skew, both in gold and in its counterpart out there, silver. So what's been lighting it up for you out there from a vol perspective in the metals this week?
Well, let's see. I'm going to take a look at that 1,000 lot first because that was a block trade. So we'll have to, if I can get a chance, I'll look at that 1410 strike and try to find it. As far as the vol goes, obviously, again, the same thing. Market tanked, S&P market tanked, and people had a little bit of a flight to both quality in terms of the rate products and also to the metals products. So we saw about a 2.5% increase here, like you said, and you know, with part of that coming today, about $5 or $6 coming today, and vols up, right? So we have a move up, vols up, and as we've talked about over the time that we've been on the show, we've mentioned how, you know, the gold product actually flips back and forth when it comes to how the curve looks, right? So this rally was no different. You saw a big jump in the bid to the calls and the offering of the puts. So as we were running away from those puts, they got offered, and as we were moving into the calls or the expectation of upside, 25 delta calls are getting bid. So again, a little bit surprising to some extent because, to me anyway, because we are sort of moving back into old territory. But I think that, you know, it's similar type of potential overreaction to, well, we're going to go up now, that, or I feel like, you know, even if the stock market and the S&Ps calms down, there's still sort of that tension out there. So metals are probably going to, I would imagine we're going to stay, you know, we might get back into, we were in that 1,200 to 1,300 range for a long time when we were talking. We were in that 1,300 to 1,400 range. So maybe we'll start breaching that 1,300. Maybe that's why we see in the bid, because there's a chance for us to overtake that landmark price again, and then move into a higher range, especially with a lot of the talk that's going on about, you know, I don't even want to get into it. It just frustrates me so much. But yeah, definitely increased volatility. And, you know, people, again, I think they're chasing upside there. That was part of what was happening. And then a definite flip in the quick skew. You saw just really, really significant increases pretty much across the board, at least out, you know, to the 6-month time frame where calls are bid, and then puts definitely getting much more offered. So could potentially even be people selling the puts and buying the calls as we run away from some of the strikes, or people just flipping their positions, taking advantage of the fact that they think that we're going to move into a higher territory with the gold. So that's really sort of the most important thing I wanted to mention was the quick skews indicating that, you know, we see a definite shift in what the vol curve looks like.
Speaking of quick skew, you guys have a lot of questions about that kind of stuff, so let's get into them. We got a few minutes left with some of your questions now in the futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to the Futures Options Feedback. You guys got your feedback for us. Let's see how many we could squeeze in. We talked a lot about S&P 500 this week, as you might imagine, top of mind for a lot of people this week. Big index week. We got some questions here. Let's start with this one from Chris Thomas. He says, Nick always talks about the taking advantage of the skew. What's this? No love for me here. Is it the Nick show? Fine. We'll just talk about Nick. No, I'm just teasing. He goes on to say, creating a collar, buying the underlying, selling a call with the high vol, and buying cheap put protection, or doing the opposite of that trade if the put has higher vol. I don't have much experience with futures. I don't have as much experience with futures as I do with indices, but, quote, taking advantage of the skew, quote, using SPY, for example, would certainly have lost a ton of money over the past few years. He puts in parentheses here, if you shorted stock, sold puts, and bought calls, I am definitely leaning more towards selling spreads on the side with high skew in futures, because that has made a ton of money over the past few years in SPY, and I don't see you be making money on these collars. Any opinion on this? As always, thanks for everything you do, and thanks, Nick, for the awesome software. Well, there we go. We got a fan of Quick Strike there, Mr. Nick. That's good. A lot to unpack here. Let's start with his definition of taking advantage of the skew. We talk about that a lot. You're right. We do mention that. And that's something every savvy options trader should do, whether it's an S&P or whether it's an Apple options or corn, whatever you're trading. That's what you should be doing, is taking advantage of the skew. Your definition of that is a little bit different. You mentioned, like in the S&P, for example, selling puts and buying calls. That is one favorable way to take advantage of that, because as Nick outlined earlier in the show, pretty much in any given environment, the S&P puts, downside puts are going to be bid and the calls are going to be offered. So selling those puts, buying those calls is taking advantage of the skew. You add in this short underlying component. We've never really advocated that. You're talking about effectively taking advantage of the skew would be taking advantage using the option. So you're putting on what's effectively a bullish risk reversal, selling puts at a high volatility, buying calls at a cheap volatility, using the combo there to leg into what is approximately a long delta bullish underlying position. That's taking advantage of the skew. If you then come around and hedge it with short futures, yeah, you're right. You would have got clobbered over this past year. But I don't think Nick and I have really advocated that much. Maybe you're getting that confused with collars, which I think you mentioned a little bit later too. It is a little bit confusing, I understand, because people have been writing in a lot asking us, hey, what about collars? What about collars? What about collars and silver and every other product on the planet? A collar does have an underlying component. It's a long underlying, so usually long the futures, let's say an S&P, and then you're buying puts to hedge, which is with the expensive portion, so it's not taking advantage of skew, and you're selling calls, again, the inexpensive portion of the vol, so not taking advantage of skew there, but you're hoping the rally in the underlying futures will offset that, and you'll do all right with that. So that's where the collar has an underlying component. Taking advantage of the skew by itself, that's just risk reversals. You want to sell puts where they're expensive, buy calls where they're cheap, and vice versa. Sell calls when they're expensive, buy puts when they're cheap. So a favorable setup for a collar would be the opposite of what we're seeing in the indices right now. It would be, let's say, what we saw in soybeans about a year ago, and sometimes in the metals and other things where the puts are cheap, so you're buying them because they're very cheap, so you can hedge your underlying position. Hopefully you have a nice rally in the underlying, and then also you have calls that are extremely expensive, so you could sell calls and get paid for it, and maybe even get your protection for free. That's a very favorable way to take advantage of the skew and use it as a collar. What you outlined isn't really doing that, but still interesting stuff. Nick, he mentions your awesome software here, so clearly a fan. What do you have to say here for our friend? I know you're looking at some setups right now in silver as well, so maybe we can use silver as an approximation as well.
Yeah, I think it was a good that I was going to touch on what you mentioned as well, right? Because and again, we said it again in this show, like we say every time we talk about the indexes. You can't really take advantage of the skew in the S&P so much, at least from the classic way that we try to use quick skew, right? Because if you look at quick skew and you look at any of the indexes, it's just a big wide channel that hasn't changed very much. You'll see it tilt here and there where it gets a little bit tighter, but it's never so narrow that you can't already drive a truck through it. So definitely not a situation where I would be looking at quick skew to look for a trade opportunity unless it got really narrow, right? So when it comes to, we're really generally talking about the commodities, the products that swing back and forth, like the golds, like the oils, when you start to see things get bid or offered. And for me, and just as a note, even when we've been coining it the quick skew the quick skew trade. Even when I look at that, when a put or call becomes expensive in relationship to the call or put, I always think of it as doing the collar or doing the risk reversal, and then you're going to be naked long or short when you do that trade. So the other thing I like to think about when putting that position on is to hedge it, not hedge it with futures, but to hedge it with a synthetic underlying by doing the at the money call and put. So either buying the call, selling the put if you want to get long, or vice versa if you want to get short. Because what that's the whole point of the quick skew implies volatility. The whole point of that trade is to take advantage of the disparity between the 225 delta volatility values. At the money volatility is always going to be the strike. The call and the put are going to be the same volatility. So what you're really doing is you're really selling the expensive volatility, buying the cheap volatility, and then hedging it with the at the money volatility, right? So then if you do have a switch where the call becomes offered and the put becomes bid and vice versa, depending on the direction of your trade, you're hedged from a completely option-based position, delta-wise. You may or may not be long or short Vega. You're going to probably be long a little bit of gamma with that trade, but you're hedged, and you're really just looking for volatility to come back in line. And that's really the idea behind quick skew, is to kind of show you when the curve might be tilted too far in one direction or another, or when it just might be where you lay off those particular things and you're better off trading around the at the monies. So yeah, taking advantage of the skew is definitely something you want to do. Think of it from a volatility standpoint, and I always think of it as hedged from a synthetic hedge standpoint with the at the money synthetic future. And then in terms of taking advantage of the skew, again, I wanted to mention as well when we were speaking about gold, silver quietly, and you don't really pay attention too much to that, but and I happen to have a reason to look at it this week, but open interest is up is over 8% that week, and the future itself is up over 5%. There's a little bit of a bit in volatility, but you did see the calls definitely get much more expensive this week, and the puts got a little bit more offered. And you saw, like a 58% increase in September and the 225% increase in the October for the 18 strike. Okay, so you had SEP, AK, and NOV contracts trade for the 18 strike on this 5% move up. We're still $1 away, but 5% got you about 85 cents this time. 5% is going to get you a similar amount, a little bit more the next time. But you see there was some bullish plays in the silver, and you're going to see that play out in the fact that the curve tilted towards the call. So calls got bid and the puts got offered. So great question. Glad that people are looking at the product, using the term quick skew. That's the whole point of using it, because it's meant to generate conversation around the volatility levels and how the vol curve looks in comparison to how it looked in the past. So thanks for that.
All right, Mr. Nick. That music means we come up against it. What an epic show. Hard to believe it's almost done already. Crazy. But the time flies when you're talking vol and TWIFO and quick skew and all of that fun stuff. But before we go, let's break it down really quick. I think we have time. We can squeeze in one last comment here. This comes from a good old Utah trader. He's written in quite a bit. We were talking last week on the show, what could cause vol to spike? He says, a nuke attack. Well, he didn't know how close he was to being correct. Hopefully he's not correct, though, so we shall see. But that said, before we go, let me go back around the horn. First off, again, I want to thank our guests there, Joe Sullivan JJ OKeefe from Chicago Capital Markets. If you're interested in learning more about what's going up over there on the old trading floor, what's going up in the S&P options world, well, then easy. Just hit them up. They're at SullyPod, SULIPOD on Twitter. Probably the easiest way to keep an eye on them. They'll tweet out some color, give you some flavor for what's going up on there. A lot more vibrant. The floor, everything old is new again. The floors are back. Certainly in 2017, we've had the launch or relaunch of two new ones in the options world in the past 6 or so months. And now the S&P options pit live and kicking over there at CME Group. So everything old is new again. Check them out at SullyPod on Twitter, or hit them up. They're at ccmmarkets.com. That's their website. You can learn more there. And Mr. Nick, before we go, you guys are always cooking up cool new stuff over there at Quick Strike. What's coming down the pike in the coming weeks, sir?
Let's see what's coming up. Well, we got a build going out this weekend, so we spiced up our charting a little bit to make it a little bit more crisp and clear, a little bit nicer and easier to use. Some other tools have been have been updated. Nothing really publicly, unless you're a subscriber, you're not going to see much of that. Well, you'll see it in the charts that we tweet out and also in the TWIFO while it's live. But we're going to we'll have a good run over here in the next couple of months of new stuff coming out. May even have some Bitcoin information available soon. That's a little bit of a teaser, so we'll let you know when that's going to happen. But that's about it. I think there'll be some. I think this next few months will be some good tools coming out, especially free tools that'll be available out in the CME Group website. So keep an eye on that. And if you didn't notice, CME just tweeted today how, you realize CME's got a Bitcoin index that's available. If you go on their homepage, you're going to see that index there. So for people that are interested and you want to keep track and you're not quite sure where to go out elsewhere, you can go see that index on the homepage. And maybe we'll start even covering it very soon as well.
Yeah, a rare week. We didn't get to talk Bitcoin, Mr. Nick. Maybe that's a nice break. All it took was a 1.5% sell-off in the S&P to drive Bitcoin off the front page. So there you go. Mr. Nick, well done. Check him out. And all of the stuff they do, you can kick the tires for free. CMEgroup.com/TWIFO, TWIFO, to learn more. And on behalf of Mr. Nick and our guests, JJ and Joe, and indeed myself, I want to thank all of you out there in the listening audience, downloading, streaming, subscribing, all the fun stuff that you do. Hit us up with questions. We do love to hear from you. Sorry we didn't get to all of them this week. We'll get to more next week. Don't worry. Hopefully we won't have another Fire and Fury 1.5% sell-off driving us crazy. But c'est la vie. That's what happens. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.